Do you want to learn English through podcasts? Subscribe to our channel. We help you improve your English faster by deep diving into interesting topics.
So, in today's dynamic financial world, it really feels like investing has shifted, from maybe a luxury for some.
To an absolute necessity, hasn't it?
Exactly. Whether you're planning for long-term wealth or financial independence or, I don't know, just trying to make your savings actually grow. Inaction often feels like the riskiest thing you can do.
That's right.
But here's the thing. There's so much information out there, especially if you're just starting. It can feel, pretty overwhelming.
Yeah.
Where do you even begin to cut through all that noise?
You've really hit on a key point there. A lot of people just feel paralyzed by it all.
Right.
So our mission with this deep dive is to basically act as your guide through that. We're drawing directly from a really great beginner's investment guide.
Okay.
We're going to break down, demystify 3 key types of investments: stocks, mutual funds, and cryptocurrency.
The big 3.
Yeah, and then, really crucially, get into the strategies for building a smart investment plan. Think of this as like your shortcut to understanding a skill that can genuinely be life-changing for your financial future.
Okay, sounds great. So let's dive straight into stocks then. We hear these terms all the time: stocks, shares, equities. Beyond just being a tiny piece of ownership, what's the deeper idea there for someone wanting to grow their money? What does the guide really tell us about why owning this piece is so powerful?
That's a great question because, it's more than just a piece of paper, right?
Right.
The guy highlights that when you buy a stock, you're getting a fractional claim on that company's future earnings, its future assets.
Okay.
And it's not just about the stock price maybe going up, that's capital appreciation. It's also about potential dividends, your share of the profits.
Oh, okay. Dividends.
Exactly. But what's really fascinating, and maybe often overlooked, is that historically, if you look at a diversified stock portfolio, yes, there are short-term ups and downs.
Sure, volatility.
But over longer periods, say 10 years or more, stocks have consistently outperformed inflation. And most other asset classes, too.
Wow. Outperformed inflation consistently. That's key.
It really is. So for those long-term goals, the risk of not investing in stocks can actually be greater than the risk of dealing with that market volatility.
That puts a whole new perspective on it. But, picking individual companies, that can feel like a bit of a minefield for beginners.
Oh, absolutely.
Does the guide offer some pointers on how to navigate that? What should someone do if they're just dipping their toes in?
It definitely does. The guide strongly suggests starting with what are often called blue chip stocks.
Blue chips.
And these aren't just famous brand names. They're companies with really solid market positions, a proven history of making profits consistently, and strong financials.
Okay, like the steady players.
Exactly. Think of them as the steady anchors in your portfolio, especially at the start. Then, as you get more comfortable, you can gradually diversify.
Right.
Spread your investments across different sectors, different industries. And this isn't just about lowering risk, although that's part of it. It's also about capturing growth across the broader market without needing to guess which specific company is going to be the next big thing.
Which is practically impossible to do consistently. Right?
Even the pros struggle at that consistently, yes.
Okay, that makes a lot of sense. Minimizing that initial risk. But what if you just don't have the time or maybe even the inclination to research individual companies, even blue chips? That's a big hurdle for many people.
It is.
Does the guide offer something else, maybe something with professional management and that diversification built right in?
It absolutely does. And this is where mutual funds really come into their own, especially for anyone who prefers a more hands-off approach.
Okay, mutual funds.
So a mutual fund basically pools money from lots and lots of investors, creates this big collective pot, and that pot is then professionally managed and invested into a ready-made diversified portfolio. Could be stocks, could be bonds, other assets, all picked by expert fund managers.
So you're outsourcing the selection.
Essentially, yes. And a key insight here is that this structure really helps reduce the risk of trying to time the market.
Trying to guess the perfect low point to buy and high point to sell.
Which is notoriously difficult, yeah. And for instance, in many places, like in dynamic economies such as India, you have things called systematic investment plans, or SIPs.
SIPs, I've heard of those.
They let you invest a small fixed amount regularly, maybe just $500 a month, something manageable, and that automatically averages out your purchase price over time, dollar cost averaging, essentially.
So you're delegating the heavy lifting, getting broad exposure.
Yeah.
That sounds really appealing.
It's a very popular route for good reason.
Okay. Now let's shift gears a bit to the asset class that's generated maybe the most buzz and confusion in recent years, cryptocurrency.
Ah, yes. Crypto.
It feels like everyone has a strong opinion, one way or the other.
Indeed. Cryptocurrency, with pioneers like Bitcoin and Ethereum, it's undeniably captured global attention, often because of these stories of just explosive returns.
Right, those headlines grab you.
They do. But the guide is very, very clear on this. While it's exciting, crypto is also highly volatile.
Define volatile in this context.
Volatile means its price can swing wildly. Rapid, significant ups and downs, sometimes within hours or days, much more dramatically than traditional stocks or funds.
Okay, some much bigger swings.
Much bigger. And unlike stocks or mutual funds, it operates in a much less regulated space. That inherently adds to the risk.
Less oversight.
Exactly. So for beginners, the consistent advice is allocate only a very small speculative percentage of your overall portfolio to crypto. Think maybe 1% to 5% max.
Just a sliver.
Just a sliver. And always, always use well-established, trusted platforms if you do decide to transact. It's about cautious participation, really, not betting the farm.
Okay. Fascinating potential, but handle with extreme care. That seems like a crucial takeaway. So now that we've looked at these different vehicles, stocks, mutual funds, crypto, the real challenge, maybe the art, is figuring out how to put them together effectively.
Right.
What are the core strategies the guide emphasizes for building a genuinely smart investment plan?
This brings us to what the guide really champions as the golden rule of investing. Diversification.
Diversification.
Yeah.
Heard it before, but what does it mean practically here?
It's not just a buzzword, it's fundamental. It means spreading your money strategically across different types of assets.
Okay.
So stocks for that growth potential, mutual funds for professional management and broad exposure, maybe that small, carefully considered slice in crypto for its speculative upside.
Got it. The mix.
Exactly. But beyond just the mix, a truly smart plan always starts with defining your financial goals. What are you actually investing for?
The why.
Precisely. Is it retirement, which might be decades away? A down payment on a house in 5 years? Your child's education in 10?
Right. Those have different timelines.
They do. And your specific goals should heavily influence how you allocate your assets. A long-term goal generally allows for more growth-focused, maybe slightly more volatile assets.
Because you have time to ride out the bumps.
You have time. Whereas a shorter-term goal really demands a more conservative approach, focusing on preserving your capital.
That's a critical point. It's not just what you pick, but why you're picking it.
Yeah.
Tied to a clear timeline and objective.
Absolutely essential.
I also know the guide stresses something else. Something that kind of goes against what many new investors might instinctively want to do, like chasing hot tips.
Yes. You're probably referring to consistency, which matters far, far more than trying to chase those quick, flashy gains or timing the market perfectly.
Right. Consistency over trying to be a hero.
Exactly. The guide really emphasizes that disciplined, regular investment over a long time builds wealth much more reliably than trying to hit a home run every single time. So many people think they need a huge chunk of money to start, or that they have to be some kind of genius at predicting market swings.
Yeah, that's intimidating.
But the truth, as our source points out, is that consistency, even with small amounts, lets you harness the power of compounding.
Compounding. Einstein's eighth wonder, right?
So often called that, yes. It's really about being in the market for the long haul, not trying to perfectly time every single entry and exit point. That's a losing game for most people.
So stay the course.
Stay the course. So, as we wrap up this deep dive, let's just circle back to that core message. Investing isn't really about luck. It's not about some secret algorithm.
Right.
It's fundamentally about knowledge, about discipline, and definitely about patience. Remember those key strategies we talked about?
Yeah.
Especially that golden rule diversification.
Spreading your money out.
Spreading it across different asset types, stocks, mutual funds, and yes, maybe that small, carefully weighed portion in crypto if it suits your risk tolerance. That mix is your foundation.
Absolutely. And building on that, what really drives success isn't chasing those, overnight wins that you hear about.
It's the power of consistency. Just sticking with it. Starting early, even if it's modest amounts, keeping that discipline approach, using the right mix of investments, and making sure it's all aligned with your clear financial goals. That's what can genuinely lead to long-term wealth and ultimately financial freedom.
Well said.
So now that you hopefully have a clearer roadmap from this, maybe take a moment to think. What specific financial goal? Is it retirement? Is it finally buying that house? Maybe securing your children's education? What goal are you now ready to start building towards with this foundational knowledge?
It really is time to begin that journey.